prices don't tell you the story when it comes to inflation, because prices rise as a result of inflation. They are not inflation. I mean, that's like waiting for the sidewalks to be wet to try to forecast whether or not it's going to rain. I mean, by the time the sidewalks are wet, well, obviously the rain is falling. You got to try to look at the weather patterns and try to predict, is it going to rain? Don't wait till everything is wet and then say, yeah, it's raining. So when you look at inflation, you look at these things that I'm talking about. You look at the budget deficits. You look at the money supply. You look at the balance sheet. You don't look at the rearview mirror. Plus, as I've said many, many times, the CPI doesn't even tell the truth about how bad inflation is because of the way it's calculated, the methodology for computing it. It deliberately understates the numbers. Now I'm looking at all these numbers on delinquencies, auto delinquencies soaring. In fact, more auto loans now are getting rejected because people have so much debt they can't even qualify for the loans. Same thing's going to be happening in the mortgage market, credit cards. All this debt is exploding. Delinquencies are at the highest they've been since the tail end of the Great Recession. They're going to go a lot higher than that. So that means the Fed is what? They're going to flood the economy with even more credit. That's what happens when you can't pay back the money you've already loaned. They just make it easier to go into debt and borrow even more. The opposite of what they should be doing.
The Peter Schiff Show.
Earlier today, the government released the highly anticipated July Consumer Price Index. And this is very significant to the markets because they're trying to handicap whether or not the Fed is going to hike rates at its next meeting in September. And so the investors want to make sure that inflation is not hotter than what the Fed had been expecting, because that might turn the odds in favor of a rate hike. Anyway, the number came out and it was exactly as had been expected. The expectation was for a 0.1% rise in the headline CPI. And that was a move in the other direction from the minus 0.4 that we got in the prior month, which was driven by energy. A big drop in oil prices helped to bring down the CPI in May. And the number was still relatively low at 0.1 in July. Year over year, the increase was 3.4%, which was exactly as expected, just below the 3.5% from the prior month. Also, the core, excluding food and energy, was supposed to come out at 0.2 increase, and it came out at 0.2. Now, obviously, if excluding food and energy, prices rose by 0.2, that means food and energy went down because it subtracted or caused the overall number to be lower. And that's exactly what happened. Not so much food, but energy. In particular, gasoline, which was down, I think it was close to 4%. So there was a big decline in the entire energy complex that helped keep the rate at just 0.1. And the core, the year-over-year core, was 2.5%. Again, exactly what had been expected, and 0.1% lower than it was the prior month. And the initial reaction to this was at least inflation isn't any worse than the Fed thought. And the odds of a September rate hike went down to just 30%. And at one point, I think it might have been upwards of 70%. But now it's 30% based on the fact that the markets are now reassured by these numbers that the Fed doesn't have to hike. Of course, the numbers are irrelevant. They're backward looking. In fact, more important data on inflation came out later today that I think is far more significant than this backward-looking CPI number, and I'll get to that a bit later in the podcast. But first of all, the reason that the number was still so benign for July was the way they do the accounting. And I had forgotten about this because I had assumed a few weeks ago that the number would be hotter based on the huge rise in the oil price in July. Oil prices were up, 22% or something like that. I think we ended July 82, 83, something like that. We're right around that level right now in energy. Oil prices are about $83 a barrel. We were just below 70 when the month of May ended. But the way they calculate the CPI, they don't compare the price of gasoline or heating oil or any of these energy components. They don't compare the month end. They don't take the end of June and then the end of July. Because if they did that, the numbers would have been way up. What they do is they take the average price for both months and they compare that. So because we had this huge collapse in the month of June and prices started the month of July so low, even though they ended much higher, the net effect when you compare the average of the 2 months showed that prices were down. But that's irrelevant because what that means is that the July number, is still being heavily influenced by the big drop in oil prices that we had in June. And it's really not reflecting the surge in oil prices that we had in July. So I think the number in and of itself is pretty meaningless. And it also indicates that the August number now is going to be much worse, even if oil prices just stay where they are. They don't keep going up. The average in August is going to be a lot higher than the average in July. But I don't think oil prices are going to stay where they are. I think they're going to keep on rising. And I'll get into that a little later in the podcast. What I want to talk more about is what should have been more significant in the minds of investors as far as news that came out today on inflation in the future, which of course is what really counts. When you're an investor, it's future inflation that is going to be your enemy, especially if you're a bond investor. And in fact, the bond market, before I even get to this, the bond market didn't even rally on this number. And then it actually sold off a bit and yields ended up higher on the day. I mean, it wasn't a collapse in bond prices. The yield on the 30-year looks like it went out at 5.25 and on the 10-year at 4.69, but very little movement down. Even though the odds of rate hikes went down, the long-term bonds did not benefit from the supposed good news that the inflation numbers weren't worse than expected. And again, even if they weren't worse than expected, they were still bad. The year-over-year core is still up 2.5%. That's significantly higher, 25% higher to be exact, than the Fed's 2% target. And of course, that number had the benefit of falling oil prices that you're not going to have that benefit in future months. So, but even taken at face value, it's not a good number. And year over year, the headline number is 3.4. How does that square with a Fed that claims that its goal is 2%? 2% inflation, we're at 3.4, and supposedly that means the Fed doesn't have to hike rates. But what it actually shows is if the Fed doesn't hike rates, that 3.4 number is going up, not down. So a rate hike is not only appropriate, but it's long overdue. And in fact, a rate hike significantly greater than the 25 basis points, which would be the most anybody would be looking for, is appropriate. Small business owners are getting squeezed from every direction. Labor costs are rising, software subscriptions keep climbing, and margins keep getting thinner every quarter. Here is what most people miss. You're probably paying for 4 or 5 different tools that don't even talk to each other. One for project management, another for time tracking, another for invoicing. Each one takes a bite out of your bottom line every single month, and none of them gives you a clear picture of where your time and your money are actually going. That's why I want to tell you about Odoo. Odoo is a fully integrated business suite, a single platform that handles project management, timesheets, invoicing, accounting, all of it working together as one system to take the heavy lifting off your shoulders and let you focus on what matters. Think about what that actually means in practice. Your team logs their hours against a project. Those billable hours flow straight into a client invoice with one click. There are no spreadsheets to maintain, no numbers to chase, and no leakage between disconnected tools. You can see exactly where every task stands, who is working on what is profitable, and what is not. That is not a feature for the sake of features. That is the kind of visibility a serious business needs to make sound decisions. And here's the part that got my attention. The core apps are completely free. You can start using Odoo Project and Odoo Timesheets today without paying a dime.
In an environment where every business expense deserves scrutiny, that is a hard offer to argue with. If you want to see what I'm talking about, go to odoo.com/r/Peter. That's odoo.com/r/Peter. You can also book a free consulting session with an Odoo expert for advice. The link is in the description, and there is a QR code on your screen. odoo.com/r/Peter.
But the news that should have been more significant was the Treasury statement that came out later in the day. I think around 2 o'clock Eastern time is when they released that. And this is the official budget deficit for the month of July. And the deficit came in at $432 billion. That's 1 month. I mean, I remember that was a bad year when the government ran a $400 billion deficit for an entire year. That was a reason to be concerned. Now, that's the red ink that was chalked up just in the month of July. That is an all-time record. There has never been a July in the history of the country where the deficit was that big in the month of July. It was an 18% increase in the July deficit from a year ago. So when you're comparing, month to month, all of the other factors are evened out with respect to when the government receives money coming in from taxes and spends money. So an 18% increase. The total deficit now for the fiscal year was reported at 1.7999 trillion. So call it 1.8 trillion. That's in 10 months. So there's still 2 months left of the fiscal year, but this fiscal year, 2026, already tops 2025 with 2 months to spare. And by the way, again, this is all a bunch of government accounting, because during the 10 months where the official deficit was 1.8 trillion, the national debt rose during those identical 10 months by more than 2.1 trillion. So 300 billion more increase in the debt than the official deficit during the same period of time. Now you might want to say, well, how's that possible? Because if the debt went up, the government must have borrowed the money. They did borrow the money. They just pretend that they didn't, because the official numbers only reflect what's on the budget. So in other words, the government has a budget, and according to that budget, they plan what they're going to spend. But if they end up spending money that they didn't plan on, then it doesn't count. I mean, it actually counts because they still have to borrow it. That's why it shows up in the national debt. But when they report the official deficit numbers, they don't report any of that. For example, let's say there's a big natural disaster and the government has to spend a lot of money. Now, it doesn't have to spend it, but it decides to spend it because of the political pressure. It declares a disaster area, and all these federal funds are earmarked for whatever that disaster is to provide relief to the community. And if the government spends tens of billions of dollars on that wasn't in the budget, they just don't count it. Which is, of course, ridiculous, because every year there's some kind of disaster. I mean, they're not always the same, but there's always something. And they never just ignore it. They always spend money on it. Nothing should be off budget. Every dime the government spends should be accounted for, whether they budgeted for it or not. But this is more of this dishonesty inherent in government accounting. But of course, the bond market, right, they don't care whether the government wants to be honest or not. The bond market is dealing with reality, because it's the actual spending that ends up getting monetized, not what's on budget. And the government has to borrow money to pay for stuff, even if it didn't budget it. And this, I believe, is far more substantial and important and forward-looking than the CPI. Because when the deficit is exploding now, what does that mean about future CPIs? They're going to be even higher, because the exploding deficits means more pressure on the Fed to choose inflation. Again, Warsh is correct that inflation is a choice, but the reason the Fed keeps choosing inflation is because the deficits are so big. And the bigger the deficits get, the more pressure there is on the Fed to choose inflation, because the more economic pain is going to be felt immediately if they don't choose inflation. Because if they don't choose inflation, then interest rates are going to soar, and they're going to force the government to slash spending or significantly raise taxes, neither of which is politically viable. So bond investors, all investors for that matter, rather than looking at a backward-looking CPI that's basically obsolete by the time you get the numbers, look at the deficits soaring, the record high deficits in July, as an indication of where inflation is headed, right? Don't skate where the puck was, anticipate where it's going. And these deficits tell you that the inflation puck is headed to a much higher number than the number we got now, which is already way above the Fed's 2% target. By the way, the podcast that I recorded on Friday is now the most viewed podcast on YouTube since I've been on YouTube, which is about 17 years. It has over 300,000 views now. I've never had a podcast where so many people watched it on YouTube. I've actually posted videos, exclusive YouTube content, where over 300,000 people watched. But this was the first time that a podcast that I do. And of course, my podcasts are available on all sorts of platforms, so people listen in addition to on YouTube. But when it comes to YouTube, it was a record. So more people are listening, and that's great. And I want to thank the people who shared my podcast with their friends, because I've been asking everybody to help me spread the word, and maybe you guys are actually helping me. By the way, the podcast I did the week prior also had about 240,000 views, one of my top podcasts on YouTube. But in between there was a podcast that only had a little over 130,000 views. That's the one I did before the one that had the 300,000. I thought that was actually the best of the three. And for some reason, not nearly as many people got to view that one. The title was something like "The Fed Chose Inflation." And that was the podcast I did the day that the Fed announced that it didn't hike rates, and we had the press conference. So I thought that was probably the most important of the podcasts I've done recently. Yet for some reason, YouTube didn't show that one as often. So it got about half the views of the other two that bookended it. And so if you happen to miss the podcast on the Fed Chose Inflation, go back and watch that one. After you're finished with this one, and after you subscribe to my YouTube channel, and if you're not watching on YouTube, go to YouTube, subscribe. After you do that and you finish watching this, then watch that YouTube video as well. Anyway, also a couple of quick announcements on where I'm going to be coming up. You know, we have a conference. Shift Sovereign is doing a conference in Panama City. It's this September 17th. This was supposed to be only open to all access subscribers, but we decided to open it up, and I think there's still some more slots. If you haven't booked it, you should just go to shiftsovereign.com, and I'll see you in Panama City in September. And then following that, I will be in New Orleans October 28th for the New Orleans Gold Conference. They're telling me this is going to be the biggest conference they've had ever as far as early bookings. So I think people are starting to take an interest in what's happening in the gold and silver market. And so this should be a hell of a conference. I love New Orleans. So go to the website for the New Orleans conference if you're interested in joining me there.
Talk to any manufacturer in this country right now, and you'll hear the same thing. The pressure is coming from every direction. Rising energy costs, a tight labor market, supply chains that are still fragile, and cyber threats that get worse every quarter. This isn't one problem you can solve and move on. Rockwell Automation just put out their 11th annual State of Smart Manufacturing report. They surveyed over 1,500 decision makers across 17 countries, and what they found is exactly what you'd expect if you've been paying attention. 90% of manufacturers say digital transformation isn't optional anymore. It's the price of staying competitive. But here's where it gets interesting. Only 43% of the data these companies collect is actually being used. The rest just sits there. That's enormous value left on the table. And nearly half of them, 46%, were hit by a cyber incident in just the past year. As factories get more connected, that risk lands directly on the balance sheet. If you run a manufacturing business or you invest in one, this report is worth your time. Download it for free at rok.auto/SOSM. That's rok.auto/SOSM.
By the way, gold prices are now above 4,400, 4,407 as I am recording this video on Wednesday afternoon. The market's been closed now for about an hour and a half. But one point we were a bit higher during the day. I think we closed about $25 off the day's highs. Silver had a bigger pullback from the highs, but it's trading above 65 at 65.21. It was above 66 earlier today. Now, it was already strong. The precious metals in general were stronger even before we got the CPI. And they got a little stronger as a result of the CPI, but not much. And you know what I think is interesting is the last several trading days, the gains have been taking place in Asia right away. Buying is coming out of Asia, and there's some bit of a pullback in our time zone in the US. And if you recall, when we had the big gold and silver rallies that ended when the Iran war began, at the end of February, early March. If you recall those days, and I was talking about it on the podcast, but during those days, we were seeing all the strength in Asia. Obviously, that's where the buying is coming from. Like the Chinese are buying when they're awake, not when we're awake. That's when they're asleep. So the big buying is coming out of Asia, which makes sense because that's where all the surpluses are. And so they're accumulating. Foreign central banks are accumulating gold. And so I think that trade, that de-dollarization trade, is back on. And the disaster of a situation that we created in Iran, and I'm going to talk more about that in the last segment of the podcast, but that is, I think, fueling the resurgence of the de-dollarization trade. But in the meantime, I want to stay a little focused on the debt. The national debt now is over $39.85 trillion. So we're now less than $150 billion away from 40 trillion, which we're going to hit that obviously within the next month, because last month we ran up over $400 billion of debt in a single month. And so we only need about 150 billion to get to 40 trillion. That is the big number. That is what investors should be paying attention to. The rest of it is a bunch of noise. The monthly CPI numbers are immaterial. They're obviously going to go up because of what we're doing on the fiscal side that is ultimately driving the monetary side. And in fact, look at Trump now, again, upping the pressure over the last week or so on Lisa Cook, right? Trying to get rid of Lisa Cook because he wants to substitute her with another lackey who's going to be voting for rate cuts. That's what he wants. Trump wants rate cuts. He wants more quantitative easing. But of course, we've got more quantitative easing. In fact, look at the Japanese yen. I've been talking about this. We're back above 159. The effects of the intervention are wearing off. Soon it'll be north of 160 again, which means they're going to have to intervene to stop the yen from falling, because if they don't do that, it's going to put more upward pressure on inflation and long-term interest rates in Japan. The yields on the JGBs will be under pressure as the yen goes down, and so there's going to have to be more intervention. And what does that mean? Well, that means that the Bank of Japan, or Japan, is going to have to bring more U.S. Treasuries to the Fed that the Fed is going to buy so that Japan doesn't have to sell them. And one interesting point that I didn't even bring up last time when I talked about this is these repurchase agreements have a maturity of 30 days. So in theory, Japan is supposed to buy these treasuries back from the Fed in 30 days. Now what's the odds they're going to do that? Because where are they going to get the money to buy them back? Obviously, if they had the dollars lying around, they wouldn't have needed to do the swaps in the first place. So they're obviously not going to do it. So what are they going to do? Are they just going to constantly roll these things over every 30 days? Now, what happens? I'm not sure. What happens if Japan just says, we don't want to buy them back? I mean, I don't know if they're required to buy them back or that's just an option. I think they decide they can just leave them with the Fed, and then the Fed is stuck with them. Then it's just pure QE, right? Because now the Fed would have bought those bonds, but instead of going into the market and buying the bonds, it would have just bought them right off in Japan. So it's a direct benefit, a direct subsidy to Japan, because Japan ends up getting out of its bonds at a higher price than it otherwise would have received if it had to sell the bonds into the market. But we still end up creating inflation. But now we have a pathway for the Japanese to unload these bonds without crashing the market, because the Fed is basically going to say, I got you, don't worry. We'll do an off-the-books transaction. We'll buy in bulk, so you don't have to hit the bids in the market. So we'll see what happens. But this is what investors should be focusing on. They should be looking at the budget deficits here. They should be looking at the budget deficits in Japan. They should be looking at the yen. And again, prices don't tell you the story when it comes to inflation, because prices rise as a result of inflation. They are not inflation. I mean, that's like waiting for the sidewalks to be wet to try to forecast whether or not it's going to rain. I mean, by the time the sidewalks are wet, well, obviously the rain is falling. You got to, try to look at the weather patterns and try to predict, is it going to rain? Don't wait till everything is wet and then say, yeah, it's raining. And so when you look at inflation, you look at these things that I'm talking about. You look at the budget deficits. You look at the money supply. You look at the balance sheet. You don't look at the rearview mirror. Plus, as I've said many, many times, the CPI doesn't even tell the truth about how bad inflation is because of the way it's calculated, the methodology for computing it. It deliberately understates the numbers. Now, we're going to get the PPI tomorrow, which probably does the same thing, but the PPI has been running hotter than the CPI, which in and of itself is a leading indicator of where the CPI is going. But as I've pointed out, looking at the import-export numbers, which are far less adjusted than the CPI, that's a better indicator of prices. But again, when you're looking for inflation, you don't look at prices. You look at money supply, right? Even Milton Friedman. Inflation is everywhere and anywhere a monetary phenomenon. So if you want to know where inflation is going, where is money supply going? Where is credit going? And it's going to continue to expand. And in fact, even now, I'm looking at all these numbers on delinquencies, auto delinquencies soaring. In fact, more auto loans now are getting rejected because people have so much debt they can't even qualify for the loans. Same thing's going to be happening in the mortgage market, credit cards. All this debt is exploding. Delinquencies are at the highest they've been since the tail end of the Great Recession. They're going to go a lot higher than that. So that means the Fed is what? They're going to flood the economy with even more credit. That's what happens when you can't pay back the money you've already loaned. They just make it easier to go into debt and borrow even more, the opposite of what they should be doing. Now, by the way, too, another thing I wanted to point out is the politics, because I alluded to this when I did my last podcast about the radical swing that we're having in America to the left. And it's both parties. Everybody wants to focus on the fact that the Democrats have moved left. We have all these Democratic socialists. Well, we got a lot of Republican socialists, including the one that's in the White House. Both parties are moving left. The problem is it's hard to figure out who is the cart and who is the horse. Are the Democrats going left and pulling the Republicans left? Or are the Republicans moving left and encroaching on the Democrats' territory? And now, in order to create a bigger contrast, they got to move even further left. It's all about promising something for nothing. And that's what both parties are doing. And the Democrats don't want to get out-promised by the Republicans. So as the Republicans start becoming a more socialist, then the Democrats have to be even more socialist than that. So again, it's hard to know, but everybody is moving left. And that's unfortunate for the country. And as we're going to get this crisis, and that's why I keep telling everybody, to promote my videos, my podcast, to repost my X posts, to get people to understand that the source of the problems that we have right now are government. And if we just double down on more government, we're just going to have even bigger problems. But look at the political races that we just had. There were 3 significant races, and in 2 out of 3, the far left Democratic Socialist candidate prevailed. And in the one race where that wasn't the case, that was for the primary for the governor of Wisconsin. In that case, it was a close race, but the Democratic Socialist, she lost to the more moderate mainstream Democrat. But if you look at the reason she lost, it wasn't because people rejected her policies in the Democratic Party. No, they loved her policies. That election seemed to turn on electability in the general. The strategy of her opponent was, look, maybe you like her ideas, but they're not going to play in the general election. So if you nominate her, we're going to have a Republican governor, because you're going to turn off the moderate Democrats so much that they're going to jump ship and they're going to go Republican. And so that was it. It wasn't like, hey, reject her ideas. It was, her ideas are great. It's just unfortunate that Republicans won't buy them, or maybe some of the Democrats won't buy these great ideas. And so we might end up with a Republican. And so that was really the reason. It wasn't a rejection of democratic socialism. It was more an idea that, that the state was not quite ready for these great ideas yet. And so they had to settle for less socialism than what they would have ordinarily have preferred. But in the other races, which are U.S. Senate, so those have more national implications. Michigan, right? You had that Abdul al-Sayed, who won in Michigan. In fact, that actually put Michigan in play now. They're actually thinking that this guy is so radical left that he may lose, that the Republican may in fact win in what would really be a blue state. I doubt it, because again, I think the economy is going to be so bad, people are going to hold their nose and vote for this guy, even if they ordinarily wouldn't. But of course, a lot of people aren't going to have to hold their nose. They love the smell of socialism. And that's because they've never really experienced it. That's why they love it so much. It's the people who have really lived in it, they're the ones that hate it, because they know that the promises are never kept. And then we also had another, where was the other election? There was another Minnesota, Peggy Flanagan, who was lieutenant governor. She won there, and she's the radical left candidate in that race. So in 2 out of 3 races, the one that was further left in the Democratic primary won. But again, when people want to contrast this with Trump, they act as if both parties are moving in opposite directions, that the Democrats are moving to the far left and the Republicans are moving to the far right, and the divide is getting wider. That's not what's happening. That's all BS. Both parties are shifting left at the same time. It's just that the people who are looking at Trump just assume that he's the radical right, just because that's how they want to portray him. And again, they never talk about the radical left or the extreme left, right? It's only on the right where you're radical or extreme. But if you really are on the extreme right, the way the political spectrum is organized today, the extreme right would be anarchy, would be no government at all, which isn't going to exist. But what happens as you go right, you get more freedom and you get less government. That's a good thing. As you go left, you start losing freedom and getting more government. And that's a bad thing if you actually understand how that works. And that is the direction we're headed.
Quick question. Are you hiring in another country right now? Because once you do, things can get complicated fast. But that's where Pebble can help. You can send offers in minutes to anyone in the world and get them onboarded fast. I've dealt with this firsthand. Once you start working with contractors and employees in different countries, suddenly you're juggling local labor laws, contracts, payroll, compliance issues, tax questions, and you're stitching together 3 or 4 different tools just to stay organized. It eats up time and it introduces risk. That's where Pebble comes in. Pebble is an AI-powered global HR platform built for founders and operators who are hiring around the world. It lets you hire, pay, and manage talent in over 185 countries with onboarding that can be done in minutes. Instead of bouncing between separate systems for contracts, payroll, benefits, and compliance, Pebble brings everything together in one place. Built-in guidance and local expertise, so you don't have to become an HR lawyer just to expand your team internationally. The fastest growing companies are using Pebble to stay organized and reduce risk. Bottom line, it simplifies global people operations so you can focus on growing the business instead of worrying about paperwork. Their new standard discounted pricing at $399 per month per employee helps you contain costs. Go to highpebble.ai to get a free estimate. That's highpebble.ai for a free estimate.
By the way, another reason that I think the Republicans are going to have such a hard time with the 2026 midterms and 2028 elections is the sheer corruption of the Trumps and the exploitation of the presidency for personal gain. Even the president's youngest son now, Barron Trump, he's still a teenager, I think. I'm not even sure if he's 20 yet. I forget. He's now worth $150 million, according to independent sources. $150 million. Not even 20. I mean, he had no money before Trump was elected president. His father became president, and now his dad's president, and he's parlayed that into $150 million. And also, I was one of the first people to criticize the concept of charging your subscribers to Truth Social $100,000 to get Trump's posts, a few seconds early so that you'd have a trading advantage. And now they've got 10 people, right, that are paying this about somewhere between 60 and 100,000 a month. And I immediately criticized this. And now, of course, there are more people that are criticizing it. But just this week, DJT Media that owns Truth Social, they came out and they officially defended the practice. And they actually had the gall to say, well, this is standard. This is normal. This is how businesses operate. It's normal to charge premium pricing to get premium access or early access. And I mean, is the public going to buy this nonsense? First of all, this is not a little bit extra. This is $100,000 a month. I don't know any social media service where you pay $100,000 more a month to be a premium member. I mean, this is off the charts insane. And again, you get the same information just a few seconds early. So it's specifically designed for trading. But of course, you can't talk about what's normal in the internet, social media, whatever, when you're talking about a very abnormal situation. You're talking about a company that is owned by the President of the United States. And the President of the United States has the ability to move markets because of his power and his influence. He can say something and then go out and do it. So he can directly manipulate prices. And he's now selling that. And he does it exclusively on his own platform. He doesn't post on X when he's about to bomb Iran or make nice with Iran, or when he's about to hit somebody with a tariff or do something. He doesn't go to X. He only posts that on Truth Social. So you've got a company that's owned by the President of the United States that has exclusive access to the president's posts, and now they're charging money for it. And they claim this is business as usual. I mean, this is off the charts, what was going on with the Bidens. So this, as well as the weakness in the economy, the runaway inflation, this is going to come back and bite the Republicans. So even as the Democrats, you would think they're self-destructing with these horrible candidates have a very good chance of winning. And so I want to make sure that if they win, the ideology doesn't. And that there's still a lot of people out there that understand free market capitalism. And that's why they got to listen to my podcast. And I'm glad that now we're starting to set records. I also wanted to circle back and talk a little bit about markets, because I haven't said anything about Bitcoin. And I wanted to talk about it in this podcast because what's interesting about the last week or so, and particularly the last few days of this week, the first few days, we've had a big rally in risk on and risk off assets, especially the names related to AI. All the tech companies, the AI names, have had huge rallies off those big lows. Now, some of that was because we basically flushed out the hedge fund situation awareness, right? Had to sell out a bunch of his liquid positions. And I think after that came out and we got some more earnings reports and some more news that kind of rekindled the speculative spirits in these names, we had a big rise in all these stocks. Like even SpaceX, which was getting beat up for good reason, probably the most overvalued stock there is as far as looking at the sales and earnings or lack thereof. But now SpaceX is back above the IPO price. So there was a speculative fever lit. And at the same time, we had the big rally in gold and silver and in mining stocks, which again, last week they were up over 20% in 1 week. And, they rose again a little bit this week. Metals prices continue to rise. I think that trend is going to continue. So we got gold and silver, inflation hedge, they're going up. And then you've got tech stocks, they're going up. Now you could argue some people are buying tech stocks as an inflation hedge, but in general, they're looked at as a different type of investment. Yet look at Bitcoin. Bitcoin did not do anything. In fact, Bitcoin is a little bit lower than it was a week ago. It's lower on the week. As I'm recording this, Bitcoin's about 63,500. It's not going anywhere. It's not rising with the tech stocks like it once did. It's not really rising with gold and silver, which it never really did. But it's not going up at all. And I keep seeing all these people claiming, well, just wait, it's going to happen. They're saying that there's a lag, that gold and silver move first and then Bitcoin follows. Says who? I mean, maybe it happened once before, but once does not a trend make. Just because something happened one time, even if it happened 2 or 3 times, doesn't mean it's always going to happen. And I keep hearing these crypto guys saying now they're bullish on gold, silver, and Bitcoin. I'm seeing more and more people in the crypto community who used to trash gold because they said, look, Bitcoin's the new gold. Bitcoin is digital gold. You don't need gold. Now they're trying to wrap Bitcoin in this gold wrapper by saying Bitcoin is just like gold and silver. They're all going to go up. It's just that gold and silver are going up first. Bitcoin's just going to go up last, but it's going to go up more. Says who? Who says it's going to go up more? I mean, that's just wishful thinking if you want to give people the benefit of the doubt and say it's wishful thinking. Because it could just be outright lies, right? They're trying to talk their book. They're trying to pump the thing up. But a lot of these guys do believe it. I mean, they're so caught up in it that they actually believe this nonsense. But they think if we just hold Bitcoin long enough, it's going to go. No, it's not. The longer you stay in Bitcoin, the more of the gold and silver rally you're going to miss out on. And eventually, the bottom's going to drop out of Bitcoin. I don't really know what's holding it up now. Certainly it isn't Michael Saylor because they're still selling. But there's just hope. I mean, that's what's irrational hope. And of course, there's probably still fear. I think there are people that own Bitcoin that are afraid if they sell it, then the train's going to leave the station without them, right? So they don't want to give up. But at some point, you're going to see that kind of capitulation. In fact, somebody was making the point on CNBC, and they were making this as a bullish argument in favor of Bitcoin. And he said that if you look at the ETFs, that so far in the ETFs, there's been very little redemptions, that maybe only about 10% of the people who bought the ETFs have sold. And in his mind and everybody else's mind on CNBC, oh, this was good news because it showed that this is strong hands. And in my mind, it was like it's bad news because we've had this 50% drop and barely anybody has sold. So what's going to happen when they do sell? Yes, maybe they've stuck it out for the first 50%. But once we really start to go down, once Bitcoin cracks below 50,000, going to 40,000, 30,000, I don't think that all these ETF investors are going to go along for that ride. They're not holding, ride or die to eternity, right? They are not true Bitcoiners. If they were, they wouldn't own their Bitcoin through an ETF. Now, would they? They would have it in their own private place with their own keys. Although even that, I read a story recently about people who had their Bitcoin in cold storage got stolen. They didn't even have it on an exchange. They did everything right and they still lost all their Bitcoin. But these guys, they're not going to go down with this ship. They are going to bail out at some point. So the fact that most of the people who bought the ETFs and who are now losing money, the fact that they haven't thrown away their hand yet doesn't mean that they're pot committed till the end of the game. No, they are going to take their chips to another casino. And in fact, the more the AI stocks heat up, the more pressure is. It's like you're over at the Bitcoin table and no one's making any money. They keep rolling sevens and you see all these people jumping up and down and screaming at the AI table. They're rolling number after number. They're all making money. Everybody's partying. How long are you going to stay at the cold table before you move over to where the hot shooters are? So this is what's going to happen. So the industry, the media, they're trying to keep everybody in the pot as they get boiled. Jump out of the pot before you get boiled and get into real gold and silver. Don't wait for Bitcoin to catch up. It won't. Just get out now. Recognize you're on the wrong horse. You don't have the fastest horse. You have the slowest horse if you're with Bitcoin. And before that horse ends up in the glue factory, get on an actual horse that's running in this race. Anyway, I want to now talk a little bit about the war. And, I hate to say I told you so on this war, but I told you so. You go back to the very beginning. Go back to the podcast that I recorded the day Trump started bombing Iran and claimed the whole thing would be over in a matter of days. Then it was a matter of weeks. I was joking. It was just like COVID, like 2 weeks to stop the spread or whatever it was. I said he opened up another can of worms. It was another quagmire, another forever war. And I said eventually Trump was going to have to surrender and pretend he won. That's what I said week one. And that is really exactly what he is doing. And I'm not even like a military strategist. I mean, I just, basically decided this was going to happen just based on my experience as a citizen. Every time the U.S. makes the mistake of getting involved in the Middle East, right? The definition of insanity is doing the same thing over and over again and expecting a different result. Going in the Middle East and thinking that you're going to get out right away is insane. And Donald Trump was right as a candidate and as a president the first time he was in office, not to bite, not to make the mistake of doing the insane thing. And then when he did it, I just all right, I've seen this movie before. I know how this ends. And this is exactly what's happening. And the crazier thing about it's not just Trump saying he won a war that he's clearly lost. Look at what he posted on Truth Social on Saturday, August 1st. I never really got into this because the post happened after I recorded a podcast. And then by the time I did another podcast, it was already pretty obvious that it was all BS. But on X, I posted about this thing, and I said that I didn't believe it. But it was the most complete statement yet that the war was over and that we won and that the Strait was going to reopen. Trump basically said that he was calling off his massive strike because on the Friday before that Saturday, he was ready to have a massive strike that was supposedly going to be the biggest strike since World War II, right? It was going to be like the biggest invasion since D-Day, except, we weren't going to have boots on the ground. It was just going to be a massive air strike against Iran, and it was supposed to happen that weekend. And then Saturday, I forget what time of day, it might have been in the morning, Trump called it all off. Hey, we reached a deal, and he said, it's a great deal. They reached out, sir, please don't bomb us. We'll give you what you want. We got a great deal. And Trump posted that the deal will include the total opening of the Strait of Hormuz and an end to the Iran nuclear threat, right? No uncertain terms. We got a deal. The Strait's going to open and no more nuclear threat. And in fact, he even followed up. It was on Sunday or the Monday, or even Scott Bessent. They came out and said the Strait is going to open probably tomorrow, right? All of this was BS. None of it has happened. Nothing has opened up. There is no deal. And in fact, the Iranians have made it clear that there's not going to be a deal, that they are not going to even negotiate on a nuclear deal until their terms are met. Their terms, not our terms. And what they're demanding before they will even consider the nuclear deal, right? What do they want? They want the U.S. to pull out of the region, pull our ships out, our troops, all the sanctions lifted. They want war reparations. I mean, I think they're talking about $300 billion, something like that. And they want to be in control of the Strait of Hormuz. Yeah, they're willing to open it on their terms. They want to collect the tolls. This is all the stuff that they want. And then if we give them all this stuff, then they'll talk about a nuclear deal. I mean, this is where we are. We couldn't be further away from a deal. Yet Trump keeps pretending that a deal's not only around the corner, that he's already got one. But now you're getting stories, credible stories in the media, right, that they're just looking for an exit ramp. And all Trump needs to claim victory is for the Strait of Hormuz to be open. But how is that victory? We had an open Strait of Hormuz before the war started. So now we've redefined victory to getting things back to the way they were before we screwed it all up. Now, I know some people will say, well, but look, we blew up a lot of their ships. Look, their beautiful ships are on the bottom of the ocean and we destroyed a lot of their weapons. Yeah, we did. We destroyed a lot of their weapons. But so what? They can build those weapons back. I mean, they can probably get better weapons. Strategically, economically, they're in better shape now than they were before. Now, yes, the guys that died are not in better shape, right? We killed a lot of the leaders, but look at the new guys. And again, it's the same regime. It's not a change of the regime. As far as I know, the guys that replaced the guys we killed are even more hard-lined than the ones we killed. And obviously, there's probably more resentment for Americans, because we killed a lot of civilians. We killed all those girls at that school. I mean, how hard is it going to be to recruit their brothers to do some kind of act of terrorism. So I think that we've made more enemies in the region. But more importantly, and I said this from day one, I said that Iran wins the war by surviving. And they've actually more than survived. They've actually done better than I thought they were going to do. And so this is a huge blow to the credibility of the United States. Yes, we did show we've got great weapons, although we've blown up a lot of our missiles and bombs. We don't have them anymore. It's going to cost us a lot of money and take years to rebuild the arsenal that we wasted. We really didn't need to blow up all those bombs and missiles, because what did we accomplish? Absolutely nothing. We didn't accomplish anything. But what we accomplished is we made Iran look tough. We made Iran look good. The leaders could say, we stood up to the United States. They attacked us. We were the victims. They were the aggressor. Yes, they killed a lot of our people. But you know what? We stood strong to the great Satan. They couldn't knock us out. They knocked us down, but they didn't knock us out. We're still standing. And you know what? We have more prestige than we had before. We have more credibility. And they're going to end up controlling the Strait of Hormuz, which was completely open before. And now they're going to be controlling it. They're going to have more influence. We are going to have less influence in the Gulf, less influence in the Middle East. And that also has the potential to blow up the whole petrodollar. We had good relationships there, at least we thought, to keeping Saudi Arabia and other countries selling oil in dollars, holding dollars, buying treasuries. That is all going to be in jeopardy if we are less influential, less powerful. And, hey, if Iran can stand up to us, then other people can stand up to us, right? Other countries that are even in better shape than Iran. So this factor of the fact that, yes, we have this big military in the United States, no question about it, but we can't do everything that we want, because we didn't want boots on the ground. We didn't want troops. We wanted to accomplish it all through our superior air power, but we couldn't do it. We couldn't achieve the objectives that we set out, even though we have this superior air power. And I don't think that is something that we really needed to demonstrate to the rest of the world, because now the world will feel that they can stand up to the United States. There were some people that thought the world is not going to go away from buying U.S. treasuries because, we've got all this military, like we're going to force people to buy our treasuries. Well, we're obviously not going to be able to do that. And so I think this was a public relations disaster, a military strategy disaster. It blackened our image. Yes, I know some people say, look, we destroyed all these weapons, and so they're not as big a military threat. They were never really a military threat to America in the first place. So we extinguished a non-existent threat. But what we created is a bigger economic threat. And Iran's going to get reparations at some point. They're going to get stuff out of this, because all we could do is drop more bombs, which we're obviously not going to do. Because how many times did Donald Trump say, I am going to bomb the hell out of Iran. I am going to lay waste to the country. I'm going to destroy all the bridges, the power plants. I'm going to bomb them back to the Stone Age. And every time he called it off with another lie. He pretended that the Iranians were coming up with these great deals. They obviously weren't doing anything. And there's a limit to how many times you can cry wolf. At some point, the villagers ain't buying it. And the Iranians aren't buying it. And so it's clear that Trump does not want to follow through with these threats. And so why should the Iranians even care? He can make all the noise he wants. And they're perfectly fine with the status quo. They're going to wait out the elections. They've even said that. They said there's no point in negotiating with Trump. We'll just wait for a new president. Right? And they're going to get a new president. Now, a lot of the Republicans think, well, it's going to be J.D. Vance. No, it's not. This is worse than the hostages and Jimmy Carter, right? Carter had a hard time getting reelected, not only because we had a bad economy, but because of the situation in Iran with the hostages. Well, now Iran is holding the Strait of Hormuz hostage to a Democrat becoming president. It wasn't an accident. Ronald Reagan won, and all of a sudden, they let the hostages go, right? So the same thing might happen. Hey, you want to reopen the strait? We got to get a Democrat in the White House. So that's going to be another thing that the Democrats have going for them. So again, I hate to be right on this. I know I was right at the beginning. I was hoping, and I said that. I said, this is how it's going to go. I hope I'm wrong about it, but I wasn't wrong. And again, it's not 100% for sure, right? I mean, they could do something to salvage this, but it's looking pretty obvious. In fact, the main reason I think that the markets didn't collapse, because there was a huge rally based on all the BS stories about how the war was over and we won and the strait was going to be opened. The reason I think the markets didn't reverse all those gains when they realized that it was all a bunch of BS. And to me, I don't know why anybody even bought it in the first place. I mean, how could anybody believe anything that Trump posts given his track record of what he's already posted? But I think the reason that it didn't fall apart is because of the idea that the war is really over anyway, because we're not going to bomb, but the strait's going to be where it is. Oil prices are going to go higher slowly, and we're just going to muddle through. In the meantime, Donald Trump's going to be doing exactly what I said. He's going to pretend this is a victory, because he does that about everything. He pretends the economy is great, even though it's lousy. So why not pretend he won a war that he clearly lost? Anyway, that's it for today's podcast. Again, hopefully we can break the record. It's going to be a high bar to clear to get to beat the last podcast, but maybe, you never know. But after you finish watching it, share it with your friends. Again, like and subscribe to this YouTube channel. And if you're not listening to my podcast on YouTube, that's fine. You can always go to YouTube and you can like and subscribe anyway, just to help get the algorithms up, get the views up, so more people hear the truth and understand the economic realities. Bye for now.